really interesting too, just having sort of traveled some of this journey with you, was that it prompted you to reach out to an ecosystem of, I guess, primarily sort of financial Twitter-based people who were more heavily immersed in this space on a daily basis, right? The Ben Eferts of the world and Himmelsteins and Mike Green, and so there's a lot of sort of discussion around this type of thesis in certain pockets of the financial ecosystem. And I'm just, so how did some of those relationships evolve and some of those conversations work out?
Yeah, I think what's been really interesting for me is how people's view of how the market operates seems to be largely dependent on the type of assets they operate within. And I think a lot of us come into the markets through sort of the equity doorway. A lot of us read the Ben Graham and we have this idea of stocks equal discounted cash flows. And you start talking to people who operate in different markets and they go, well, that might not be the case. Let me show you a different sort of idea. So the three main narratives that I largely heard, or at least there were three main trunks of narratives. There's a lot of sort of branches, but the three main trunks were the Fed has totally distorted markets. The second narrative is passive investing or indexing, which are subtly different. We can get into that, have distorted markets. And the other one was this idea of sort of a liquidity mismatch that was existing between the liquidity being provided by high frequency traders and the liquidity taken by hedgers during stress market environments. And depending on who I spoke to, a lot of times they were very convinced that their narrative was the driving force and the other narratives weren't applicable. And it's actually been really interesting as I get feedback from the paper. A lot of people, for example, in the world of ETFs are saying, you've massively overblown this idea of indexing's impact on the market. And then you talk to someone else who perhaps is a little more skeptical about the impact that the Fed is having. Ironically, the derivative folks are all going, no, you nailed it. Derivatives are totally having an influence here. But I think you do have to be in the weeds of that particular topic. So someone like a Ben Eifert, who really truly has an expert knowledge of the way structured products are hedged by banks and how the option surface and implied volatilities have changed due to the adoption of structured call overwriting and put underwriting programs by endowments and other institutions, is really invaluable knowledge that someone who's going out there and buying an individual small cap value stock because they think it's undervalued, they're just not getting the same view of the market. They're literally looking at it from a totally different angle and potentially not understanding some of the external forces that are actually driving what's going on from a sort of supply and demand perspective.
Yeah, no, I think you're right. And it was, I think one of the real edges in your paper was that you didn't really get married or bogged down in any particular narrative, right? So you've got these three competing narratives and you're able to sort of dig a little bit deep and ask some nuanced questions in each of the different domains. But by analyzing the three domains together, you're able to sort of triangulate a little bit and maybe zero in on the true causal forces or some of the things that actually might be going on fundamentally and how those forces interact with one another. And so it actually is probably useful for, I found figure one in your paper to be really instructive. It sort of ties together all the major themes in the paper. Do you have it handy? Can you kind of walk us through it?
Yeah, absolutely. Let me pull that up really quickly. And figure one sort of looks like, let me get this open for you. Let me know when you can see it.
Yeah, we can see it.
So figure one is what I called sort of the current market incentive loop. And I think when you first take a look at this, it's overwhelming and maybe it looks a little bit like, you see those old fashioned crime dramas where they're drawn, red string between everything and it starts to look a little bit tinfoil hattish. But the basic idea here that I've laid out with these different narratives is they're all operating almost in a bit of a flywheel, a bit of a loop that all interacts with each other. And they all sort of have second, third order effects that occur. And so where I sort of picked up the thread was in 2008. That's sort of how I looked at things as the experimental monetary policy that the Fed adopted and introduced over that time served as an accelerant. I think you can certainly go back to the late 90s and say that there was the beginnings of the Fed's influence on the market started then, but I think the Fed had a much heavier hand introducing a lot more experimental policy into the market in 2008. And that really had sort of two effects. It showed that the Fed was willing to become an active player in the market, no longer just a referee, but truly an active player in backstopping the market. And it suppressed interest rates in a way that forced investors, especially investors with real dollar liabilities, to have to move up the risk curve. And in moving up the risk curve, investors go from, say, U.S. Treasuries that used to get them 4, 5, or 6%, and now all of a sudden have to buy equities or alternatives or move into strategies that they think can get them pseudo-equity-like returns, but with some risk management characteristics. So volatility contingent-like strategies. Investors abroad started looking at structured products to try to generate yield where bonds were no longer sufficient. And so you have this mass adoption. Now, you can argue that sort of move up the risk curve actually creates sort of a perpetual bid for risk assets. And then by forcing investors up, that actually balloons sort of the demand side of the equation for these risk assets and actually has lifted all these risk markets over the last decade. Now you take that and you think, okay, these investors now all have to put their money to work in these risk assets. One of the big ways in which they've done it has been going into equities and largely migrating from active to passive strategies or active to indexed ETFs over the last decade. And that's had some interesting effects potentially from a cross-sectional pricing perspective within equities, as well as the way in which sort of markets operate on a microstructure perspective, that no longer are there active managers going out and buying individual securities, but when a dollar is now allocated to a strategy, it's largely allocated in a basket-based manner where that dollar is now being used to just buy a set of securities regardless of value. Sort of the market makers who are facilitating that trade know the price of everything but the value of nothing. You keep moving along the loop, and if we do hit some sort of market disconnect, say a catalyst like the Corona crisis that sends the market skidding off, we tend to see a situation where high frequency traders pull back the amount of liquidity that they provide, largely due, it seems, to the fact that they're operating with a tremendous amount of leverage, contingent upon the collateral they can post, which is often securities based. So when markets get more stressed, they have to pull their liquidity. But at the same time, a lot of those strategies that investors have adopted are volatility contingent. So again, these structured products or ways in which investors are searching for yield, like trying to sell options, buy puts, all of these things caused force hedging by either option dealers or banks that ultimately is liquidity taking. And so you get this pro-cyclical effect that as liquidity is getting removed, more and more investors are trying to take liquidity, which causes markets to draw down further, forcing further hedging. And you get this liquidity sort of cascade crisis that requires the Fed to come back in, backstop liquidity, and sort of set the whole loop in motion again. And I think that's what just happened in March and where we are today. And so I think the big question is, does the next decade actually echo the past because of this loop?
Right. Yeah. I mean, extraordinarily comprehensive, and there's a lot of moving parts and a lot of feedback mechanisms. What struck me too is you had a chart that you, I think, pulled from a Callan Associates report that showed that investors seeking, so a typical institution, right? They've got either fixed liabilities or they've got fixed payment schedules, and so they've got a required return in order to not fall behind on their liabilities and or be able to meet these payments. And so the typical pension requires, say, 7.5% return, which on its face seems just absurd in the current environment. But if you make the assumption that you can indeed stretch to take on enough risk to generate that 7.5% return, it requires 3 times as much volatility to achieve that return today as it did in 2006 I believe that was the reference year, or sorry, in 1995, rather. I think that was the reference year. And what struck me as I went through that is that those are mean returns. So if you've got a mean return expectation of 7.5% at a 6% fall, your compound expected return is sort of 7.4%, right? But if you are generating a mean return of 7.5% with a 17% fall, your compound expected return is closer to 6%, right? And this volatility drag term scales exponentially as vol increases, right? So there is a point at which just mathematically you will need to stretch so far into risk space that the vol drag will overwhelm whatever marginal benefit you get on the mean expected return. And so there's a cap, right, to the total compound return that can be generated from this market. And beyond that cap, if that cap is lower than the required return for an institution's liabilities or its cash flow promises, that represents a singularity event for these institutions. So
Well,
it is an interesting sort of potential one-directional end game for how this kind of plays out. Just one of many.
I think for me, when I started sort of going down this question of, okay, rates are suppressed, so what? My question was, well, why do people have to move up the risk curve? Why can't we just accept less return? And the answer, at least as I found it, became, well, because there are certain people who have far dated liabilities that just because rates went down doesn't mean they don't owe $100 20 years from now to their pensioners. Mm-hmm. They still have to hit that return that they've promised, regardless of what's happened to base rates or sort of premia. They've made a promise, and either they're going to default on that promise, which has all sorts of economic consequences for us as Americans, or they're just going to have to keep moving up the risk curve until they can try to find a return and try to stomach the volatility. And ironically, by moving up the risk curve and adopting riskier and riskier strategies, they might have both simultaneously, from a supply-demand perspective, pushed returns up in the short term by everyone sort of moving up and demanding more equities, but also compressed those premia going forward. And I think we've seen that in the volatility space. And to your point, if they keep adopting more and more and more volatility, that compound growth rate as compared to that, sort of arithmetic expected return starts to take a nosedive.
Yeah, absolutely. And that has profound impacts on even sustainable withdrawal rates for retirees. It's not just institutions, it's anybody who is needing to lean on their savings to generate income to support financial objectives. So I think profound effects for everybody.
I think for me, anecdotally, this was very obvious over the last decade with a lot of the advisor clients I worked with, where they started to look at things like private REITs. They started to look at things like MLPs and covered calls and introducing all that stuff to their clients to try to supplement yield for retirees and stretch in every which way they can. I actually just sort of put out a question on Twitter saying to folks, look, 10-year rates in the US are very, very low. It's a great predictor of forward returns over the next 10 to 15 years. If you're an advisor charging 1% and the 10-year rate is 70 bips, what are you doing with the 40 of your 60-40? And I'm not here to say there's a death of the 60-40 by no means, but I think it's an interesting question to ask. And almost all of the answers I received involved people moving up the risk curve in some capacity.
Yeah, and certainly they're moving up the risk spectrum in a traditional sense, like they're moving into deeper credits, or they're moving into higher beta equities, or et cetera. They're selling more volatility, or they're moving out the complexity spectrum, right, into products that probably advisors have less intimate understanding of the internal mechanics of, and certainly by proxy, the end investor has much less understanding of. And so, you're either taking risk in complexity or risk in terms of volatility or probability of losses, but you're taking risk either way. And, I read down through that thread, and I have to say, I don't know what your reaction was, but I didn't find any of the answers particularly satisfying.
Well, I mean, I'll tell you personally, I don't think I've come up with a super satisfying answer myself. So I'm not here to judge because I'm living in
Agreed.
a glass house, right? This is a really tough problem. What struck me as interesting is as I sort of tried to dig through the answers, was it seemed like there were people who were trying to solve what I would call sort of the yield problem of bonds and people trying to solve the capital preservation problem of bonds. I think we have been so fortunate over the last 30 years that bonds gave you both. And so what you could sort of see was there were people saying, okay, I need to think about how I can generate 5% yield for my client, because there's still this idea that, hey, the best way in retirement to sort of make it through retirement is clip 4 or 5% coupons. I'm not going to get into a debate as to whether that's better than just generating total return or not. I'll leave that up to someone else. But there is that mentality that people like to know the coupon is there. And so people are searching for that yield. And then there's a whole other base of people saying, this is supposed to be the stable anchor of my money. Maybe I can look at things like equity long short. Maybe I can look at things like some sort of structured product with a defined outcome. And I think sort of regardless which path you go, it's all sort of plays into the narrative that I played out, that you're either sort of selling optionality somehow or moving up the risk curve in a way that I think continues to put more and more conditional stress on the market.
Yeah, no, I agree.